But today we're going to be talking about like tail risk and why it's so important and how we can quantify it and how that's going to like lead into some of the topics that we talked about a couple of days ago. Make sense?
Makes sense.
Perfecto. So just to quickly recap, on Tuesday, we covered some returns distribution moments and how they can be used to quantify historic stock risks. So this is looking at like the mean of the returns distribution, the standard deviation. We also talked a little bit about skew and we talked about kurtosis. But option P&L distributions are highly skewed, which is why we need more comprehensive ways to measure tail risk. Short option P&L distributions have negative skew. And what that means is that most of the occurrences are concentrated on the positive side of the mean, which is why, that's a representation of those high pop strategies that we get when we trade short options. While on the other side, on the negative side of the mean, there's a very large tail. So that kind of demonstrates that very large unlikely tail risk. And those are like the characteristics of a negatively skewed distribution, right? Correcto? Correcto. So here's an example of what that looks like. So here are two figures from the book, actually, looking at the distribution of 16 delta SPY strangles and their per trade P&Ls. And this is looking at it as a dollar amount. But here we can see, again, that really negative skew. So while the positive end of this chart range goes to $2,000, the negative end can go to $8,000, right? The very, very large but unlikely tail risk. There's really not a lot of occurrences that have reached this level of loss. But because that's still a possibility, depending on what you trade, you still need to keep that in mind. And here we're also looking at that having those positive concentration of occurrences, positive side of the mean, showing our high pop strategy. So this is the strategy that has, I think, like an 80% probability of profit historically. And you can kind of see what that looks like when we have that negative skew in a distribution here. Make sense?
Makes sense.
Cool. So to recap, what a consequence of having the skew is that we need better metrics for estimating our tail risk factors. And there's a bunch of different ways that we can do that, but one of the ways that I like to do it is by using conditional value at risk and value at risk. So to recap, value at risk gives a potential loss of a portfolio or position over a given time period and at a given likelihood level. So for example, an example of what that would look like is over any 1 day period, one can expect to lose at least $1,000 at most 5% of the time. So this kind of tells us where that threshold is for the extreme losses of that strategy. And I can say like, okay, so I can expect to lose at least $1,000 or more at most 5% of the time. It kind of tells me in an extreme situation how much capital could potentially be at risk, right? Yes. Conditional value at risk is a more extreme estimate of that value at risk. So CVaR is an estimate of the expected loss of a portfolio or a position if that worst case loss threshold, the value at risk, is ever crossed. So basically what that does is it looks at the value at risk and the distribution past that value at risk, and it takes the weighted average of all those occurrences, and that tells you an even more extreme estimate in those worst 5% of cases, right?
Yes. And which one do you prefer to use out of the two of them, Julian? Both of them?
It depends on what I'm trading, honestly, but for options, just because that tail can be so big, I like to use conditional value at risk, right? Because there can be a pretty big difference between value at risk and conditional value at risk, depending on like how long your tail is and how heavy that tail is. And we're kind of look at some examples in a second, but does that make sense so far?
Yes.
Cool. Okay, so CVaR is a more sensitive metric to tail losses, and it provides a more conservative risk metric, which when you're dealing with like certain types of short option strategies where that tail loss could potentially be, where it's undefined, it could potentially get very large. I prefer to use the more conservative metric, which is CVaR. And it's also normally used for undefined risk strategies rather than defined risk strategies, because CVaR for defined risk strategy is basically the same as the BPR. It's basically the same as the mask loss, so it's a little bit better for undefined risk strategies. You don't really use it for defined risk strategies like spreads or iron condors. Make sense?
Makes sense. That's the one I should be using.
Well, again, depends on what you trade. If you're trading stocks, it might not make as much of a difference. But again, because that tail can get so big, because those losses could potentially get very large, even though they don't happen very often, then it might justify using CVaR instead of VAR. Make sense?
Makes sense.
Fabulous. So here's an example of the returns distribution for SPY from 2000 to present. So here we're looking at a CVaR of -2%, so nearly 3% actually, and then a VaR of about 2%. So we can see how that CVaR gives us a more extreme estimate of those tail risks for on any given day. So basically, in the worst 5% of cases, SPY lost 2% or more, right? And we can kind of look at that to say, like, okay, on a daily basis, how much can I realistically expect to use or to lose based on past performance? Make sense?
Makes sense.
So this is what it looks like for SPY, where you don't have as much skew. It's still like not perfectly a normal distribution, but it doesn't have nearly as much skew as the options, options example. So here we're looking at the P&L distribution. So all of these are just different P&Ls. They kind of fit into different boxes, and then the boxes are going to be different heights depending on how many P&Ls fall into that box, basically. So for 16 delta SPY strangles that are managed early, so 45 DTE and managed at 21 days, right? We can see how different the VaR and the CVaR are in this case. So here we have this very big tail skew, or very big skew that results in this very large tail. We can see how most of the occurrences are positive above that 0 mark, but the tail can potentially get to like 2,000% the initial credit. Those are like very worst case losses, at least recorded for this particular strategy, right?
Right. Yeah.
Right.
That's a big tail.
There's a big tail, and we can see in this example how big the difference is between VaR and CVaR. So here, your value at risk is about 100% the initial credit or 116% the initial credit. So like worst case, in the worst 5% of cases, the strategy lost 16% the initial credit or more. But in the more extreme example, that jumps up to nearly 288% the initial credit, right? So it's a pretty big difference between that VaR and that CVaR. And using that CVaR can give you a more conservative estimate, like, okay, in the worst case scenario, at least historically, what can I expect to lose, right?
Yeah.
So pretty different when you have a distribution that's so heavily skewed like this. And it's also good to talk about, I guess, why we would use CVaR versus the BPR. And this is kind of where it comes in a little bit using defined versus undefined risk strategies, because BPR, especially for undefined risk strategies, can be used to estimate usually the worst case loss pretty reliably, given the current market conditions. We can do a whole other piece about BPR. It's actually very interesting on how it's calculated, but it's basically the amount of money that you have to put up to open and maintain a trade. It's kind of like escrow. It's like the amount that you have to hold to maintain a position that your broker kind of has as like insurance. If this, starts to take losses, then we have some money. And then if it doesn't take losses, or if it doesn't take too much of a loss, we get that money back, right?
Yeah.
And then that capital gets released. And it's intended to sort of encapsulate about 95% of the potential losses with ETF underlyings and about 90% of the potential losses with stock underlyings. So it's really designed to give you a pretty reliable estimate of sort of worst case loss, how big could that potentially get. But CVaR can actually give you a slightly less extreme version of that number. So it's always good to keep the worst case loss, or the worst case. It can exceed the BPR as well, but it's good to keep the BPR in mind. But the CVaR can maybe give you a little bit more of a, I don't know how you describe it, a little bit less extreme of an example, right?
Yeah.
Make sense?
Makes sense.
We good?
Definitely yes.
Cool. So CVaR is one that I use quite a bit. And here's just an example of how it looks on the platform. So this is a SPY strangle in the December 15th expiration. So here we can compare the BPR and the CVaR. So our BPR is about 6.5K. And again, this is the capital that you need to open and maintain that trade. And in a lot of cases, this represents like the biggest that a loss can get for this position. Although for undefined risk, it can definitely get bigger. There's been a couple instances where that happens, but max loss is roughly around here, at least based on a rough estimate. The CVaR is actually significantly less than that. It's actually about half, right? Or a little bit less than half. So we can see that based on simulations. We're going to talk a minute about how like these types of values can be calculated, but we can see that like the worst 5% of cases where that threshold is actually a lot less than the BPR. So you want to keep both into account, but if you're trying to guess like, okay, realistically, how much money could be at risk, then we can use the CVaR and we can see how that might change how we budget position sizes and that kind of stuff.
And the CVaR, that represents the worst scenario can happen in a day or overall in at the end of the position.
So again, like it's always good to look into the documentation of your particular broker to kind of like see how they calculate it. Every platform is going to be a little bit different. But some of the examples that I showed before about those P&Ls are a lot of the time it's calculated to expiration. So how much can you lose by expiration? Not so much throughout the duration of the trade, but again, you should look into like each particular broker and the documentation that's calculated there, right?
Yes.
Cool. So helpful to kind of look at both. And when we look at how it can be estimated, a lot of the times, like in the examples that I showed, you use historical options data to calculate that. But historical options data, when we want to put that distribution together, it's usually expensive and very difficult to get, especially for certain underlyings and strategies, like maybe, like 20 delta Microsoft calls or something like that data. There's not a lot of that data, or it's kind of hard to come by. So there's a way that we can actually simulate different outcomes that we've talked about before, where you can calculate the current CVaR of an option or a strategy or whatever using simulations, right? Do we remember this one?
Yeah, you want to show this?
Yeah, it's a Monte Cristo, JK. It's a Monte Carlo. So basically,
1,000. No, it takes 1,000 or 10,000.
This one I think is 1,000, but you can again, every broker calculates like CVaR differently. You can use however many occurrences that you want. Basically, if I want to I want to calculate the CVaR of an option. I have the prices of my options, but I don't have the options historical data. I can take the characteristics of my stock. I can take like the volatility. I can take the average return, all that kind of stuff. I can take those characteristics of the stock and I can simulate different prices and different price outcomes over the duration of the trade. So using those simulated price trajectories, which I can just use, which I can do using Brownian motion in Monte Carlos, I can calculate, okay, by expiration, what are the worst 5% of P&Ls for this particular strategy? You just take the average of those extreme losses and the weighted average, and then voila, you have a CVaR. So this can be done maybe even in Excel. I don't know. I usually do Python, but like you can simulate these different stock price trajectories and you can kind of put together all the possible outcomes, at least based on like models that you can maybe expect. So it's a way that you can kind of calculate it yourself and maybe say like, okay, so if my strike is breached by a crazy percent, like 40%, what's my worst case scenario? That kind of stuff.
Did you put a cat here under the microscope for that graph?
That's actually, I'm just speaking absolute gibberish. I didn't use Python for this. It's just a bunch of cat hair.
1,000 portfolios where you can end.
Yep, it's 1,000 portfolios, 1,000 different trajectories. And what's nice about this simulated, even though like obviously simulations and reality differ all the time, what's nice about this is like if you put in like weird complicated strategies, like I have a 10-legged option strategy, whatever, you can calculate all these different simulations and you can calculate the possible outcomes, which gives you a lot of flexibility as a trader if you like to kind of do more quantitative decision making and that kind of stuff. So thank you guys for watching. I hope this taught you a little bit about VAR and CVaR and spooky, scary skeletons and tails and whatnot. But yeah, I hope this taught you guys something. Yeah, thanks for watching. I'm glad you liked the chart, Brandon.